Good morning, everybody, from the west coast of sunny Florida. A little chilly today here in Tampa. And for some reason, I'm going to leave Florida and go to an even colder place this weekend, New York City, for some relaxation and fun and restaurants, of course. So, anyways, I thought we could, thanks for everybody for being here and for the talk about trend following and lovers of trend following, the skeptics of trend following plus nothing, or trend following plus some other things. So the forum is open, and you can go crazy on whatever you think might be interesting. I thought I'd start off by sort of an end of the year summary. You know, it was a good year. It's probably the best 2 years I've ever had trading. Risk adjusted, leverage adjusted. I've traded larger and had better years, but the past two with the commodities, especially, we waited so many years, kept the commodities in there. I kept them around 40 and 50% of my portfolio. So I finally got some benefit from it. And I started expanding my portfolio of commodities into South Africa, sunflower seeds, and Brazil, and Malaysian palm oil, and all the others that had some big moves. But I thought I would just try to rattle off a few things that I learned and experiences I had from 2021. And if anybody wants to pick up on that, that'd be fine. I'm interested in what people are taking away from, the good and the bad. I certainly could have done better. I didn't have a lot of stock exposure. The stocks that I had were going down most of the time, except I had a couple of huge moves. So maybe that means I did have a good year in stocks, I guess. But then I have a few elements to my trend following system that are sort of wimpy. I have a method that if market starts to crash and it gets too close to giving back a material part of my profits before my system exit is hit, I'll reduce the position. And that really didn't work out that well for me. It worked out in a few markets, but then it was a complete failure in some other markets that once the market did crash, I got out of a bit and then it went back onto new highs and made tons more money. And if I got back in, of course, it was with an ATR much greater. The position was much smaller, blah, blah, blah. So woe is me, sad story on not being 100% systematic and perfect. And but I'm glad that, I'm a little skeptical of taking away the lessons that don't support what I think is the correct way to trade. So it sort of reinforces like um, my trend following philosophy not to have other exits and um, stick with the system. So maybe this year I'll get lucky and my parts of my approach that don't work very well, that are sort of counter trend or not purely systematic, they will do better. And I'll just have to remind myself that I got lucky. Um, Richard had some really good tweets this week. You can pick up on some of those. The week edge I thought was pretty interesting, but he has lots of good ones. I was reading through them this morning, but that's some other good stuff to talk about. But I'll open it up for others if you want to talk about last year or whatever's on your mind.
Hi to everyone. Very happy to be here, as I always say, and I'm sure that we'll say always these words. And I want to say that this year was very good for me because of commodities exposure. And I have told you before many times that I began to trade commodities because of inspiration that gave Niels and Jerry and Maritz for me. And one of them said, maybe Maritz, I don't remember exactly, that not having commodities is not safe factor for your portfolio. And commodities done really well. And I think I can talk a lot about how useful, and I do it periodically, how useful to be to have a commodities in your portfolio. So this year was incredible good because of my knowledge that I get from the podcast, that I get from Jerry, from Nils, from Maurice, and so very great, yeah, because of this, and not have very big results. Currencies, not good, not good performance there, and from stocks also not so much perform, but commodities did perfect.
Hey, hi guys. Hi everyone. I just would like to come in this currencies crush that Oleg is feeling. I'm on the same boat. Um, Currencies have been a pain in the neck for me this year. A couple of trades did well, but most of them did not. Commodities stole the show, but the currencies and the stocks did not go very well. And I'd like to reinforce here. I'm very grateful for this opportunity. It's great to talk to you guys, and that's it.
Hi, everyone. Great to be here. G'day, Jerry. I just wanted to warn people we've just found an imposter using Jerry's, an almost identical Twitter handle for Jerry. So we're just sussing him out at the moment. But look, last year, I thought it was a great year. It sort of fermented my philosophy even harder. I know that, on I had a good listen to Derek's podcast yesterday, which was great on mean reversion. But they were calling out these fundamentalists, and I suppose I do it. I do actually embrace the philosophy that I'm a fundamentalist. But look, I just want to make sure that I think everyone realises where I stand on this. So I don't want to be a thorn in the side. So I think I'm very happy discussing trend following, but I'm certainly, I don't want to stilt or stop, considerations of other
You're so
methods
shy
if
about trend
necessary.
following, Richard.
Sorry?
You're so shy about trend following, Richard. I don't know why you get this impression that people wouldn't know where you stand.
Yeah, well, it's interesting. People say, this is sort of preaching or a fundamental viewpoint. But all I'm expressing is that I believe it. Trend following is, I sort of live in this world of asymmetry where I don't regard all methods as equivalent. I don't regard statements such as, "Oh, find the trading technique that suits your personality." I'm more in the empirical world where I'm looking for things that I'm looking for this asymmetry where certain methods are better than other methods. All I see in alternative methods is playing around with risk. It's what I regard as a window dressing mentality, a bit like an accountant. Now, my background is in finance and in accounting, and I certainly know how to window dress accounts to make them look very smart. And I think that's what a lot of people actually do in trading. They're either doing it psychologically, some are doing it deliberately, but they're trying to smooth out this inherent nature of investment returns. And when we look at any form of complex adaptive system, we recognise that change is not um, progressive at all times during the nature of that system. Change occurs in fits and starts. So you must expect that your returns are going to occur in fits and starts. If you find that you are getting consistent returns all the time, that is a process that you are adopting, which I believe is what I call risk avoidance or risk transference. In other words, it's playing around with risk, which I believe is not in the interests of investors, because inherently the nature of this market has taught us again and again and again that markets are inherently chaotic at some points in time, and no matter how clever you think you are, you will come undone possibly at any time, but you might last longer than another. So to me, it's no different to a gambler turning up at a roulette table as opposed to a considered prudent investor who is managing risk at all times. So that's why I have this philosophy about trend following. That's why I sort of do sort of wrinkle my nose at smooth returns, and so I just wanted to express that. I know everyone accepts that, but I don't want you know my views to stilt conversation. So I probably got to find this happy place in trend following where I stick, and I tend to be sort of happier there rather than wander out into these alternative methods.
I think that this idea of avoid risk, people like this idea, not to have risk at all. Have a lot of money without doing anything or something like that. But in fact, we all know, and it's not my thought, it's thoughts of really good professionals in business people, that there is no way, if we want to be perfect, if we want to be high performance, there is no proven way to avoid risk. We can only reduce risk, learn it, and reduce it. And I'm absolutely sure that it's the right approach.
Hi guys, just want to refer about last year performance on my part. 2020 was a great year for me, but 2021 not so great. And the main difference I think between me and others or, here in this channel is that I trade shorter term, and I also don't put equities on my trend following on the trend following side of my portfolio. By design, equities are managed in another way. So I was listening to you carefully, and I guess that the main issue for me was that I was trading short term, because many of you said that you didn't get much from equities on 2021. But I will say that it was a little different for me, and I guess the culprit is that I've been trading short term. That and the fact that I trade between 40 and 50 markets, which I don't know if it's too little of a number.
Yeah, that's very good. I would say that it was my choice of equities. I start with a fixed universe of markets and a fixed universe of stocks that I'm going to trade with my trend following long and short. And I just did too good of a job. I was too diversified. I didn't have enough stocks that just went up. I'm going to add Microsoft and Google and Amazon to my list one of these days, because then that'll give me this S&P performance based on earnings and growth in the market. And so I just was too much in Beyond Meat and DraftKings and Canopy Growth and weird, unusual stocks that just had a mind of their own and could have been a bit, um, could have had a bit of good performance during a COVID period, but during a recovery, they just lag so far behind. So I think that stocks, definitely trend, and I have no trouble long-term trend following stocks. I think if I looked at my stock back test alone, it would say you should even be longer term with stocks, for instance. I wouldn't necessarily go with that, but if you did want to just look at the equities, they just, especially during the last 10 or 15 years, where anytime that you got short or flat, it probably would have been better just to stay long in most of these. So I love the stocks. I'm going to keep trading them. I just didn't get that pop that everybody else got being long, but I think the stocks are great. I like them. I think they have one characteristic that is a turnoff, and that is they historically they don't do well on the short side. And I've tried to figure out ways and use inappropriate filtering, and still haven't been able to. Even if I did something incorrect on the back test on purpose, I still they still don't look very good on the back test on the short side. I remember telling this to Rich one time, 20 years ago. I was talking stock trading with him, and his response was, "Well, ignore that. They'll probably be great one of these years on the short side." So, I think that's the right trend following philosophy to have. You can't predict these things, and just because commodities were bad for 10 years doesn't mean anything. Stocks shorts have been bad for a long time. That doesn't mean too much. But I do think that they do have some inherent characteristics about shorting that probably is, I'm skeptical, even though I still do shorts.
Jerry, how about trying to run your back test just for the just for the exercise? Run your back test on, I don't know, Japanese stocks during the 90s, or um, well, a different window and a different geography than the US in the last 10, 15 years. Perhaps then you would see some performance on the short side that could boost your confidence.
Yeah, I don't know if you've noticed this or if you have seen this, but when you're a CTA, trend following base, and you're using this ATR approach, it's probably it doesn't matter if it's ATR exactly or not, but you're sizing the trades based upon the volatility. You can kind of, before the short begins, you can kind of measure if the stock goes to zero or if the commodity goes to zero, then what is your maximum profit going to be? Now, that doesn't withstand the fact that crude went negative, and also that you have this contango backwardization built into the price series, and you don't really know in a commodity how much your potential profit is if it goes to zero because of the spreading that's yet to come. However, as a percentage of the price, the ATR is extremely high compared to the other markets, uh, like commodities and currencies and bonds. So I do think that there's an inherent issue in there of sizing based on ATR and kind of knowing ahead of time that you were not going to get an outlier in the way that you would a long, which is not a big deal because we know the shorts in general, even if that's not even an issue, we know the shorts are not usually going to be as good, but they can contribute. But as a rule, stocks are very volatile compared to their price versus the other markets. But I'm undaunted. I'm not going to worry about that too much. I'm going to continue to do shorts, continue to do short stocks. But because whenever I have historically done a heavy-handed approach to try to limit my short trades, I've inevitably underperformed painfully underperformed during a period versus my peers, and I vowed not to let that happen again.
I want to say that shorts, of course, I liked the point of Niels when he said we do shorts because we don't know and we can't know the future environment of the markets. So now, historically, we can see this that shorts are not done well. We can see this with few exceptions, maybe. But in the future, maybe it will be environment, good environment for shorts. And because of this, we do this. I like this approach, this point of Niels.
One of my guesses is that when you're doing trend following, you're kind of long-term volatility and short-term volatility. And when you go down below the moving average, etc., there are such big jumps on volatility that makes shorts lose money pretty fast. So I guess that's something. that's bad in the short term at least. Although, as you said, I will keep going long and short on them.
Yeah, I tend to think we get a bit of a reverse phenomenon happening in the long environment versus the short environment. So in a long environment, I think that we get volatility expansion early in the trend. And I think in the short environment, we get volatility expansion late in the trend. In other words, in the short environment, you get these effects called capitulation tails. And it's more a case of positive feedback when everybody is starting to panic. You definitely get that observed effect in the range of the bars towards the tail end of trending conditions. Whereas in the long environment, we get the volatility expansion and then the progressive surge. We might get a few more expansions. So I tend to think there's an asymmetry there in the relationship between long and shorts, but I definitely think they're both worth targeting.
I had an interesting moment, this year, in that if you zoom out on that anything, the Dow or the S&P, over the last 100 years, and you look at that chart, why in the world would I assign equal weighting to my shorts as I would to my longs? There are fundamental reasons why I wouldn't do that. Just, the productivity, you're going to have artificial intelligence, the productivity of these companies. Amazon's not going to be paying workers in 20 years because it's all going to be automated. They're going to pay them with WD-40 squirts. But to me, it made no sense to me why I'm assigning an equal weight to my shorts. I don't.
I think, Andy, that's valid if we're talking about indexes, but I certainly don't think it's valid if we're talking about the individual constituents of an index. So the nature of the index itself is a system unto itself, the way the index is constructed. So it's continuously over the long term rising simply because the product creators who create that index are continually rebalancing that index, and one unsuccessful stocks are dropping out of that index, and it's always being replaced with an upside bias towards the surviving stocks. So there's survivorship bias built into that index, and it's got an inherently different characteristic because it's an index, as opposed to what we're talking about is the nature of individual markets. So we'd be preferring to trade individual markets because I tell you, there is a greater success for a business to go belly up and bankrupt than there is for it to be a successful operation. And under that scenario where you can get businesses suddenly collapsing, that certainly is opportunities for trend following, but not necessarily the same can be said for an index.
I
Okay,
think that
that's very, very good point. I received that. You're absolutely correct on that. And I do trade index. So that was my bias. You're right. With the survivorship bias. At the same time, so you'd basically be looking for stocks that are not going to survive and not going to be in the S&P 500. And that's difficult unless you're selecting a universe that has qualities of such as not increasing profits and all this stuff. I just think it's a bit of a different animal. But I received your point very well.
And I'd like to add that one thing is stocks in the US, other thing is stocks anywhere else in the world. Sure, the S&P, the Dow, these indexes show an amazing performance. Now do Brazil. Things are not very pretty.
By the way, I have heard that Brazil stocks, Brazil markets are interesting markets. I don't know this exactly, but I have heard this maybe a few years ago. And I have read or maybe heard in Top Traders Unplugged, it was a guest that trades Iraq stocks. a few years ago, I have seen this information that Niels had interview with such a guy. I don't remember it exactly. Maybe I'm wrong, but I remember something like that. And I want to say that if we are talking about the stock index, about any index, we are talking always about the basket. And basket of stocks, basket of commodities, or something like that. And I have said before that stocks are very high correlated instruments. If we are talking, and maybe stock can understand the nature of stock index. But if we are talking for transformers, but if we are talking about such, I have heard that there are such commodities indexes, and it looks really very, maybe even stupid, because we have indexes of different markets, so very different uncorrelated markets like commodities are, and people do index in this, and maybe somebody trade this, and I think it's a very bad idea. And if we are talking about stock, of course, when we trade, I used advice of Niels and Maritz and Jerry that it's better to trade index stocks, not index but stocks, better for diversification. And I have mentioned that even if we have uh, very high correlated stocks, but if it is flattish period, in a correlated group of stocks, some of the signals are not involved, are not trading, and I don't lose money on that market, on that stock market. So, and if I traded SP 500 index as a whole, I would lose money. And so it's a diversification, a huge diversification benefit for me. Not only capturing the trend, but lose less when the period is not very good for you.
Something to keep in mind as well, we often talk about spread trading stocks as a means of arbitrage, and typically people, when they're referring to it, they're looking at the mean reversion qualities of that spread trade. But I'd say, well, how about looking at the divergent qualities of that spread trade as well? So here's a classic example. Over here in Australia, we've got two major mining companies, BHP and Rio Tinto. They're fairly equivalent mining companies, and we could take a position where, over the course of time, we could use a return stream that looks at, well, which one is going to outperform the other over a very long period of time. So we could take a position where we went long BHP, an equivalent position, and short Rio Tinto. Now, don't worry about the names of those companies, but what we are doing is we are eliminating the market risk associated with that investment. So we're immediately breaking the correlation that exists in a market where it all goes south. What this does is it makes it independent to the market correlation by trading that relationship. But then you look at the tails of the distribution of that return stream of that divergent spread trade, and you'll see that there are big opportunities in that for trend following as opposed to necessarily mean reversion. So it's just another way to think of how do you develop uncorrelated return streams from unique opportunities such as equities and things like that, which is going against sort of what the products that are presented to you, and it's saying, well, reclassify them, remold them into a different way that gives you a unique return stream that possesses these uncorrelated relationships that you're seeking.
Okay, based on my research and my actual tradings, I guess you actually see differentials in asset class on their performance on the short side. Commodities, I believe, are the outlier here, where they're more symmetrical. If you look at say treasuries, downside is obviously very good, compared to the upside, which is capped because of yields in the lower bound. We also have equities. Equities downside is more protected because you have something that's correlated to GDP, and that is drifting up, so it's got positive bias. So necessarily the downside is going to have a plus bias, so it's not going to be a symmetrical trade. That is kind of the difference between sectors that I found. And I also think that as in trend following part, we do make more money on the upside. And if the markets are crashing, equities may be participating a bit, but by the time it turns, you're really going to be making more money in the fixed income aspect, the FX and the commodity side of that. Going into the idea of why potentially this might happen is the marginal participant. The marginal participant in equities is normally someone who can go long only, while the marginal participant in a commodity future can easily go long and short. So the net kind of flow that can go into those two products is different. And that's also the same for fixed income. Most people are going to buy a treasury, not short a treasury future or purchase a swap that would then change their duration or do some kind of complicated structured product, unless you're in Asia and you like to sell that kind of thing, and get an auto callable or whatever. Side note, something that's even more fundamental than all of this kind of stuff on why things would be different is you lose delta when you're going short, and you gain delta when you're going long. And how am I going to explain that? If I put $1 million on a short position on stock that is at 100 and it goes to 90, I've lost 10% of my allocation to that stock or that position. I mean, it could be XYZ, it could be a commodity. So now I've got to reload to actually get the original notional position that I had before. So profiting on the same amount of units that you had going into it, when something is going down, you're losing exposure. But when you're got something that's appreciating, you're gaining exposure. So instead of it going to 900K, you'd be at like 1.1 million. And now you have that many dollars working for you on the further move up. And that is a real structural difference on how returns play out, even just like from day 0 to day 1 on a short position that will structurally affect how this kind of affects the end result in our portfolio, even though the net move, say it's a 10% up and down move, is the same.
Yep. So I want to comment on Andy and Derek, and I just to sort of say that when you step into this trend following world, I mean, I had mentors, and so they've extremely influenced me. So, but getting into this trend following world where you're going to follow price and put your brain on hold on all these other topics and ideas that you're talking about, then you're going to follow price, use these rules, and you're going to do these back tests, and your main goal is the sample size. So we're going to desire to treat the shorts just like the longs. We want to treat the commodities, the currencies and the bonds and the stocks the exact same way. We're going to ignore all of these things you brought up about shorts and longs and the different market sectors and their characteristics, because we want to say they're all the same. They don't have these characteristics. But even if and they may not, honestly, because of sample size. But in order for us to max out our sample size, which is even worse now or more important now because we're trading longer term and the back test doesn't yield as much sample size as it used to when we traded short term, that we're going to force ourselves to look at all these markets as if it's just one market, one type of trade. There's no such thing. There's no difference between long and shorts. There's no difference between the different sectors and the markets. And we're going to do all of that because we want to convince ourselves that if we have this sample size going forward where we treated everything the same historically, we can go forward and do the same thing and maybe make the same amount of money as the back test. We want those results in the future, hopefully, to be similar. Overall, we know that the exact patterns in the certain markets won't be the same, but our average trade, our average loss, our average win, we want those to be the same. And then another thing, too, is that I might not be as articulate on this one, but we're not going to look at things in percentage terms either. We're looking at them in terms of the ATR. We're not going to reload. Um, it's a trade. We're measuring it in terms of ATR. We're not changing the trade level. We don't use the 10% gain in the long for anything else. We're measuring these profits just in terms of the ATR at our entry. I made 10 ATR, 20 ATR, lost 2 ATR. Once again, we're distancing ourselves from traditional finance, I guess.
I find this very interesting, Derek. A very interesting point of view. And coming back to our trend following golden rules, one of those, I don't remember the number, I don't have them right here, but one of them is to trade small. And when we trade each market small, it's true what you're saying. It's true that we lose delta and on a short position, but if you're trading small enough, this loss is approximately linear. So it's from a concrete point of view, from a real trading point of view, it doesn't make that much, or it shouldn't make that much of a difference, this loss of delta. And then I get back to our golden rules and see even more reason to one more justification for it to make sense. I mean, it's important to trade small to avoid this loss of delta on a short position, different from a long position. And then we can come back to Jerry's comment, where we don't measure anything in percentage terms, only on ATR terms. And the reason is
No, I mean, I agree with that. I do think that you can play in the ATR space and not in the return space, but this artifact of losing the delta on your shorts will come up in your trade statistics. It will come up in your portfolio returns. It will come up in, when you're trying to make money on a mostly short portfolio if all the trends are going that way. It's not necessarily that you need to do that, but it's something to be aware of. And that can kind of maybe distort um, the amount of, say, trading profits you made, average winner, average loser, or the contribution of the shorts to your portfolio, and exacerbate the longs, which may lead you to believe you should do something different. But again, if you're trading small, it's going to be a marginal change. But if you're looking aggregated over thousands of trades, that little deviation could add up, is kind of my thinking here.
And we fight that urge all the time to not trade the shorts. And then it will have a positive impact, though, on, monthly and quarterly performance. 2014 was a great year for CTAs because of energy, short crude, heating oil, unleaded, Brent, gas oil. And then the shorts go back to being bad again. So once again, it's a philosophical choice for this being a slave to sample size. And like I had a very strict limit on my shorts in 2018 when the stock market crashed at the end of the year. It wasn't just stocks, probably. It was probably other things as well. So I had a very big restriction on going short, and I tremendously underperformed. 2008 as well. And then those were crappy trades, but I underperformed in December or the fourth quarter. And I made it all back in the first quarter of '09 when those short trades didn't really do anything. And I did not have them. It was just painful. And then 2020, oh my gosh, I had the same strict um, rules for shorts. I did not participate in a lot of those short commodities that, you know, CTAs are delivering some positive performance when the stocks are crashing. I mean, I didn't do nearly what I could have, but then I just was so in despair and like, I'm not going to let this happen again. It doesn't matter what the math says. I understand these shorts over a long period of time, they are no good. Try to restrict them in a robust way. And but then you underperform so much, with your peers that you're like, oh crap, then I'm going to let my, I'm not going to, and then it's kind of, is it robust math? I'm limiting these shorts. I mean, I think it is, but it may not even be. Plus, I'm underperforming. And then the shorts in 2020, they didn't turn out to be great either. They all rallied, but and then I'm happy about that, I guess, rooting against these short trades. But no, we're fighting that all the time. Like, why do we have to do these shorts? They're so bad. But it's really something you just have to force yourself to suck it up and do them sometimes.
Jerry, how do you select your shorts? Is it the same sectors where you're choosing your longs, or is it, you know, the discretionary component of what's happening in the macro? How do you select your shorts as opposed to your longs?
Well, I'm going if it's in the portfolio, the fixed portfolio, then I'm going to do the shorts when the signals get hit. I like to have these systems that have flat periods as well. So sometimes I will go from long to short or short to long, depending upon, the trend, of course. But I try to definitely have a period where I'm flat as well. But if it's in there, I'm going to do the short. I mean, it's a trade. I'm going to do it. Um, Another observation, I remember looking back on the shorts, like I don't remember Enron, but that could have been a really good short and a good long. You know, that market kind of rallied like crazy, then crashed because it was not a legit operation, and CTAs would have probably done pretty well on that. But I do remember like Qualcomm in the .com crash. Like Qualcomm made so much money. It was hundreds and hundreds of ATRs in Qualcomm. And then the ATR was so high that if you would have sold Qualcomm at the high, you would have made like 5 ATRs or 10, like almost zero. So that's where I get a little squeamish. Like if this stock goes to zero, I'm going to make, 5 ATRs or 10 ATRs. And the longer term your system is, the that's going to determine, your outlier, the size of your outliers. So if you say, okay, outliers are 5 to 10% of my trades, then look at your top 5 or 10% of your trades. So if I've had trades this year with 200, 300, 500 ATR profits, it's just a function of being longer term and not getting out very quick. And so, you're looking at, okay, this is what I'm hunting, and then this short's going to make me 12. If it goes to zero, it's not going to go to zero. And then if it does go to zero, or if it gets close, it's going to rally, and I'm going to get out on a rally. So it doesn't make a lot of sense. It does help make money during periods of time to keep the drawdown smaller when the longs aren't working, and it has a positive influence on your trading size of the longs probably, and your trade level. And then you just say to yourself, ultimately, I don't look at these as long and short and commodities and financials. They're all one thing. My average trade is looking at all the trades, long and short, all the markets, all the sectors. That's my average trade. I'm going to resist segregation of long, shorts, and sectors.
I like this approach very much because it's a part of our great trend following philosophy, and trading all in the same way is a very important part of philosophy.
Yeah, I think some of these, let's call it disappointment from the short side, comes from the fact that you guys keep hammering this point about hunting outliers. Obviously, you can't. You said it just before. You can't expect the same sort of ATR performance on the long side versus the short side, because the long side can go to the moon and the short side can only go to zero, or maybe yes. I mean, oil price went negative, but not very negative. It just about went negative. So I think some of this problem is sort of baked in the cake, and you should just say. I think you summed it up very well, saying, "Well, actually, my shorts should be there because they sort of help me as a hedge for all these longs, which are going to deliver these wonderful returns. And I don't care that the shorts will score very poorly compared to the real outliers in my portfolio, because those shorts don't stand a chance against your real outliers.
Yes, and just to beat a dead horse a little bit more, because I left off the end of my sentence, and that is because if you do any of this segregation of longs and shorts, sectors, markets, you have less sample size. So you have no reason to believe, you barely have a reason to believe possibly that you have enough sample size and enough evidence to go forward based upon the back test, especially like me, I trade so long term. But that's the reason, is that you don't have evidence. Slicing down the stocks, shorts, and looking at the shorts and making a claim about it is subject to, you'd have to have a fairly short-term trading system and counting up thousands of those trades. Then I think that would be probably the way to go. But I remember, CTAs and math people, they have a tendency to say like, well, we're always looking for more sample size. We just need more data. If we had more data, we would have a better indication. And that's the way I was sort of raised. But I do remember one of my mentors recently saying something like, he felt that there was enough commodities data that he could optimize using the systems he was going to use for commodities. So that was kind of a surprise, shock. I don't really believe that, I guess. I believe the old 1983 version of my mentors versus the 2021 version of my mentors, possibly. That's kind of jokey, but probably. I don't know why. I think in trading, you have to build your own philosophy and run it through your own BS meter and your own personality of how strict you really want to be, and some people like me, we just need to have this thing to fall back on, like this philosophy of how the world works. And we're always reminded it doesn't really work that way all the time. And you have issues with your grand philosophy of trading or life, but still it kind of makes us comfortable. That's what I was thinking yesterday during Derek's Clubhouse, was some of the reasons I say and do things is just because I'm weak and I need that crutch to believe these things, to keep me on the straight and narrow, to keep me from veering off into even things that could be even worse than some of my ideas that are not really that locked tight. But also I've seen people, my mentors over the years too, they change their mind and they talk one way and then they do things a different way because of their personality, etc. I remember asking them once, like I did a back test on this ATR stop loss, 2 ATRs for the turtle. And I was like, this is like really short term. It's not optimal. Like 4 ATRs, 10 ATRs is better than a 2 ATR stop loss. And the response was, oh yeah, that's just my personality. I was like, what? Personality? I don't have a personality except I want to make money.
I think it's a very interesting discussion about the personality, but all we know that we have, and I always say this, we have basic principles. In the structure of trend following is based on a principles, and we must do all what we do according to these principles. It's my opinion. There are some things that can be fit to the personality, but not all the things. And if we will listen only our intuition, our personality, in this case, I don't think it's not the best decision that will be made under this approach, under this philosophy mindset.
Jerry, I have perhaps a challenging question. How do you come to terms with the fact that the longer term systems have a much, much smaller sample size than the shorter term ones? Is it that the performance is orders of magnitude better, that even a smaller sample size is enough to give you confidence? Or do you have a different reason that's not exactly statistical?
Well, probably the latter. I'm not sure how statistical it is. That's a very good question. There's an article out there that Bill Eckhart wrote. I think it's called "The Man with 1,000 Systems" or something like that. I'll find it if you tweet me. And but he basically says that you need so much sample size, trade sample size, one entry, one exit, and a stop loss. But you can have more filters or whatever than that, of course. And you need a lot more than people think. But because it's a skewed distribution, a non-normal distribution, and it's dominated by outliers, you need even more. So I was like, oh crap, I don't like that. And then his approach is like a holding period of days or weeks. So I think that that's maybe their personality to trade shorter term, but also he's a pretty renowned mathematician. So I do trade shorter term methods, holding periods that are shorter term than my longest term. And so, as I've said before, all of those systems, I trade 4. So one of them has more trades, and the average trade is a bit smaller than the longest term. But as I've said before, all of them make about the same amount of money. So maybe I take that into consideration. But I think to some degree, since I'm not willing to do too much more than one entry, one exit, and a stop loss, and try to stay with traditional trend following, the way I've described it many times, I don't really have a choice, because the shorter term, like when I do the back testing, I'm like, okay, computer, show me the shortest term I can possibly trade. And I don't want my average trade to be so minuscule that it can't absorb some bad performance and slippage and commissions. So I'm kind of like biased towards a healthy average trade. And so then I declare that's the shortest term as I want to go. And then I trade things a bit more long term than that. So it's not a good math. I guess I could start adding more stocks to the back test, and then get lots more trades because of all the stock data that I could be using. And I'm not sure if that's legit or not, because it's like a lot of those stocks are correlated, I guess.
And I want to say that, of course, we can do, for example, in high frequency trading, we can do 1,000 trades per week or per month. And if we are trading in our normal way that I do now, it may be on one instrument. I'm talking about one instrument to be more clear in my example. And in my trade, for example, for S&P 500, I have one trade for a month. But I think that the environment of the market is the same. So that's not good math, because it's my opinion, at least, that we have, of course, a lot of samples in high frequency, but this sample don't show us the real situation, time situation, and because of the same environment. So here's my point.
And just to build on this, I wanted to go back and build on this other point, because I like bringing up these points that are kind of that can provoke, And one of the things too is that from this ATR perspective, where we're just looking at these moves in terms of this ATR, and we're not looking at percentages at all, and I'm not moving this trade level up. I'm not using the daily trade level. I always chuckle when people say, if you're down 50%, you have to make 100% to get back to break even. And like from my point of view, you know, there is extremes. If you're actually down 50%, I am going to have been making these cutbacks that are going to make it very difficult for me to get back to break even. But if I'm down 10%, I don't think I'm going to change my trade level. So I don't need to make more than I just need, if I'm, maybe I've lost 10 ATRs and I'm down 10% to get back to break even. I just need to make 10 ATRs again because I'm not changing that trade level. I'm risking that 1% of my January 1st or 25 basis points or whatever of my January 1st trade level. And so for us, we're not in this game of percentages. And then another thing that's kind of fascinating when people bring that up, if you lose 50%, you have to make 100%. It's kind of like it's an accounting thing. And I majored in accounting too. It's a spreadsheet thing. When the S&P goes down 50% and then it rallies back to new highs, it didn't do anything. There was no heavy lifting. If you put it into a spreadsheet, oh yeah, it made 100%. It was down 50. It got back to break even. Yeah, it made 100%. But there was nothing going on there. It just seems so daunting that, oh my God, don't you know that this is what you'll have to do? But it happens. It people do it. The market does it. The market does it and no one's doing anything. It just goes back up after being down 50%. Traders do it. I'm just saying this is the most frustrating thing I hear from, as if this requires some sort of ultra human, extra human ability to get back to break even. So whatever you do, don't have this drawdown because it's just impossible, and it's not. You just proper money management, proper trade size, uh, you know, um, all of these logical things fall apart if you're down 50% or 75% due to overtrading or lack of diversification. But the ATR world, getting out of the percentage world is so freeing.
It doesn't happen anything in real life. And this is the problem with mixing up leverage and other considerations. If somebody freaks out and they sell at the bottom, then they crystallize that loss, and not only you have to make twice as much in order to break even, but you're also leaving the trading vehicle or the trading program or the manager that can get you back up to where you started. So yeah, I mean, it may seem to be an inconsequential thought or just an accounting trick or some sort of artifact, but unfortunately it triggers investors' decisions, and most of the times those decisions are counterproductive for the very same investor that makes the decisions. So I think most of the um, need or want or desire for avoiding these big drawdowns, and it goes back to my one of my pet peeves, like this volatility drawdown and this negative carry that comes with it, is just that you would like to try to avoid as much as possible, because unfortunately it sort of triggers wrong decisions from your stakeholders. Probably it doesn't bother us much, but the people that stand behind us might actually get triggered by these events.
With the ATR side, does anyone here think about or give merit to the idea of capping a position size on a dollar amount based on the size of the ATR? So if a normal trade is, I'm going to give 2 ATRs of risk, if that ATR goes up quite a lot to the point where the maximum position size or the risk that normal position size would be allocated becomes tremendous, that maybe if I'm thinking risking $1,000, and now if the ATR doubles, I would take half a position size if that risk that's equivalent to that becomes extraordinary. So I can still take the trade, but I'm now just allocating less risk, but still giving it the ATR amount.
Jeff, I do exactly that. I use a fixed dollar risk using ATR. So in other words, I might assign a fixed dollar risk of say $500 per trade or $1,000 per trade, but my ATR is the method by which I then determine my position size to risk that standard risk bet. And that's the same applied across all of my instruments until I elect to change that dollar risk value, which I might do on a monthly basis to create this slow compounding effect. I think we've sort of talked about this in prior Clubhouse sessions.
Thanks, Rich.
Yeah, so I would do it a bit different. I'm not really concerned too much if the position turns profitable and then turns into a more volatile position. But I am very concerned about a small ATR when I put the trade on. And so I don't want this gap risk that can come in overnight or something. And so I use a minimum ATR for some markets like the short-term interest rates that where the ATRs can get very close to 1 or 2 or 3. So a minimum ATR of 5 or 10 in the euro dollars or the short sterling, Euribor makes me sleep better. And plus it's a small position, and because it doesn't bother me that, well, a lot of things bother me, but it shouldn't bother me that Moderna's ATR was 87 cents when I first put that on, and it's $25 now or whatever. I'm not sure what it is, but if that stock would have been 25 cents, I would probably use a 50-cent or $1 minimum ATR so that loss doesn't get too crazy. The losing trade, if it's going to, if it turns out to be a losing trade. But I'd welcome and celebrate if the profitable trades got more volatile and more trendy and more divergent. So that's the way I would look at it. But I'm all for, I remember October 1987, and the stocks crashed, and then after they crashed, the bonds rallied, that night, and they kept rallying in euro dollars. And so I was in there. I was on the phone with some of my friends at 7 o'clock, and the bonds were limit up. They were going to go limit up, I guess, when they opened the night session. And then my friends like, if the euro dollars open 100 higher, I'm dead. And I think they opened 350 higher. So be careful with those short-term interest rates. And so I soar off those short-term rates until someone on Clubhouse last year said, you should really trade those short-term rates again. And I said, yeah, you're right. So I'll put them back on. And I've made some money in them, of course, being short recently. But I do trade 150 markets, and I do use a minimum ATR.
I'm afraid a Bitcoin and all crypto in this in a gap, because I think it can be enormous gap there. Of course, it can be anywhere, but I'm afraid this market more. And I like the idea of Jerry when he said that it's very important not to be too close to price in our stop loss. Very important.
I'm thinking about this and those short-term rates and the idea of having a minimum size. I mean, you could think about it as putting a floor on your ATR such that your position size won't go too small, because that's how you're putting on your leverage, right? So if you're using a ATR or volatility-based position sizer, it can get so small that your leverage gets really dangerous. And I agree with Jerry. Not only is it not like that capital efficient to be, say, like trading euro dollar or any of these like 3 months sterling or whatever they call it. I always get the sterling and the gilt and all that confused. But bringing that back to gapping, we have night sessions even now with Globex. It's like slightly less liquid, and then maybe there's 1 hour where it's off. that's where the gaps occur. So, you may be talking to your friend at the morning if they're trading equities, and then they have gap risk, and that's why we have futures and all this overnight. But Bitcoin, I think, is different. And the reason is because it's a 24-hour, 7 days a week, even trading on Christmas is possible. And the amount of liquidity there for most participants is really high. So by nature that there is activity, there won't be a gap. And you might not get the best price, but there are multiple venues for you to hedge out that risk, which back in the day, or even now, like I said, with Globex during that 1 hour period, if, say someone drops a nuclear bomb on someone during that period, things will go to hell in a handbasket, and then there's nothing you can do. So I do think technology has helped. I think that Bitcoin is not necessarily a good example for that, just because of what the definition of gaps are. But I do find that in practical space, definitely having some kind of maximum position size cap, like the Richard method, this is the maximum I'm going to put on, or the Jerry method, which is what I do. I have a volatility floor where I will, well, not to get into details, it's like a dynamic floor, but it makes sure I don't go below some level, so that when I input that into my position sizing, the leverage just doesn't go insane.
I would just say though that Bitcoin is probably the one market where you don't have to have a minimum ATR, because the ATR is so huge. Some of the Bitcoin futures, I trade Bitcoin futures, and some of the FCMs were requiring a 100% margin. So it's kind of crazy. But yeah, Bitcoin usually is the opposite. I mean, anything can happen, but I would say I wouldn't just limit this risk that you're trying to minimize by using minimum ATRs or capping positions, um, by the strict definition of gap, because it can also be intraday. All of a sudden, there's some stuff going on. I noticed my short Russia stock position was making money yesterday due to Ukraine or something, right? I don't know what's going on, but these gaps can happen where there's air pockets during the day. So I don't limit my concern just to the overnight gap definition.
Another good thing about establishing a size limit is that you have a trade to analyze. I mean, it would be a different one, but the sample size will still be big. What I do is on the short-term interest rate, I put a limit on the notional amount of the trade.
Jerry, I think that's an interesting point. I mean, I take your point. That is correct. These air pockets that occur, not only in, I don't know if you would call Russia an emerging market, but like, say, less liquid market, less versus even in the U.S. stock market, and the idea that it's a lack of liquidity, right? These air pockets are generated by lack of liquidity, and when the exchange is down or closed, that is the ultimate lack of liquidity. But because most of the liquidity that we see in all markets now is HFT, they're not designated market makers, they're not specialists, they're people providing liquidity with an edge, conditional on the fact that they think they're going to make money. We all hallucinate that this liquidity is there, but they'll take that 5% time off, and that's the time you need them the most. And I do think that it's a kind of a negative, because even if you are doing a large sample size, the chance that you're able to see that in your back tests, because it's such a rare event and they're doing it selectively, and you don't know how they're all going to do it, but normally they'll do it in sync, then you get these air pockets during the day, and that's how flash crashes occur, right?
There was also a move from the government to try to avoid that and having more stringent
And limit
limits
us.
cross market stops and etc.
I was just saying there's some markets out there that are sort of illiquid, lumber and others, that they have a tendency to go limit up and limit down. So people panic and it doesn't take a lot to send them. That's another risk. But I remember back in the 90s, I think, um, liquid currencies. There was some crazy stuff going on in the British pound once. And I think the Bank of England raised rates in the morning and lowered rates in the afternoon. And so all of a sudden, all of these very liquid markets got very illiquid. And of course, we've seen the S&P lose all sorts of liquidity, and people panic, and the bids and the offers are crazy. So these markets can do anything and everything. I have a tendency not to trust any of them, and especially the less liquid, but even some of the financials and markets that are liquid. They'll eventually go back to being liquid again, and the bid and offers will tighten up, but it's not a sure thing every day that which markets are going to cause you some trouble.
And when these air pockets occur, and suppose the price triggers your stop, your exit. Do you execute as quick as possible? Wait for the liquidity to come back? I ask for you guys in general, who are more experienced than me, definitely.
In my case, in general, when a stop is triggered, I wait to execute at the limit of that stop, if that makes sense. I don't follow the price at market price. I wait until I can trade at that level, and if that doesn't happen by the end of the day, then I will end up trading at the end of the day.
That's a very timely question, because I'm looking at some trades now that I need to get done, and I haven't done a good job. I think I've done some studies on execution, and I had some bad ideas, and I noticed 20 years ago I had some bad ideas about how to execute and when to execute and how to handle trades. And then I noticed my slippage reports. I was having more slippage than I had before. And so the conclusion I came to, just to get to the punchline, is when your signal gets hit, start doing the trade as soon as possible. Now, you don't have to go crazy, but just participate and get it done as soon as you can. And don't be afraid to participate when the market's higher and you're buying. So it's uncomfortable. You don't like it. Everyone, I learned, from people who traded in the pits, and some of that pit mentality of not chasing and getting the edge gets bled over into long-term trend following. But I definitely think that that's how we got rid of our slippage, and we minimized it, was we started just doing the trade. There's no thinking about it. Don't have a rule. Well, you don't want to buy the high of the day. You want it to come off a bit. Start the trade and just start participating. And if it's very liquid, knock it out. If it's cocoa and coffee, then you take a half a day, or whatever, ever how much AUM and your contracts that you need to buy. And then a corollary to that rule that I've come up with is the more the market goes against you, and the more it's strong, like it rallies, and you didn't get in yet, and you're an ATR away from where you're supposed to buy, the more trend you see, the faster you should go. And the worst idea ever is they're running stops. It's kind of a fake move. It's going to come back, and there's no reason to rush. And I don't want to get caught up in this mania of buying intraday right now, because it's totally unstable. I think that that's probably true almost 50 to 90% of the time. However, I think in the long run, it's not going to be true sometimes. And if you wait for the perfect time, you're going to even buy higher prices, and it's going to get even way more out of control. And so I think that that's a painful lesson that I've learned, is do the opposite. Where everyone else is saying, I don't want to get caught up in this mania, start doing it. Just start doing it. Start participating. If you have to buy the high every 5 minutes, it's making a new high. I've seen that happen, and it just made a new high all day long. Every 5 minutes, do it. It's painful, but in the long run, I think it's better. And that's what
It's
rule
also
of trading is, that short-term pain has nothing to do with what's the right thing to do for the long run.
that Kahneman book about thinking fast and slow. You know, your slow thinking analytical brain is telling you this is where I'm going to put my stop because this is my system and this is what I have determined by using my slow brain. And then there's that pesky fast brain that is like, oh my gosh, yeah, but they're just trying to trick you, you know. And you gotta listen to the slow brain.
Yeah, thanks, guys. I execute as quick as possible. I automate most of my trades, and I've got the impression that this bad feels I get sometimes is negative for my performance. But from what I hear from Jerry, I think that's not pretty much the case. And I'm small enough to be to everything be mostly liquid for me. So this thing that coffee is less liquid than I don't know $0, and then you should trade more sparsely or trade along the day and not in the instant that the stop is hit. There's not much a issue for me. But thanks anyway, and thanks Cindy. This point on Kahneman is amazing indeed.
Bruno, also just be aware that what you're feeling now is probably because at the moment you haven't been exposed to these wondrous outliers. So at the moment you are experiencing this sort of issue of linearity, and you're experiencing slippage and all of these things, which at the scale you're looking at it now, it looks significant. It looks as though it's going to be material for your performance. However, as soon as you catch these significant magnitude events, these outliers, the scale totally changes, and you realize, what the hell was I worrying about that degree of slippage on that particular entry? Um, the scale of these outliers dominate your P&L performance. And even though it might only be 5 or 10% of your trades, and so you might be waiting up to a year before you catch your first outlier. All the time, therefore, you're worried about this sort of random signature that's capturing all of these losses, and you're finding your drawdowns are building, and you're thinking, Jesus, what's happened to my philosophy? It's when those outliers come, your faith is restored.
Yeah, you're right. Thanks, Rich.
I remember, back in the Turtles, at least in the classroom, there was this big, huge emphasis on slippage and getting good fills. And notwithstanding the fact that in January 1984, we started trading like one lots. And so all of these turtles would call up and put an order in and put these limited orders in to trade, one lots. And then maybe, I think February, we actually started trading, $1 million each. And so maybe we were doing 10 lots or 20 lots by then. But so there was this big, huge, to impress upon us how material trading costs can be. And so limit orders were the best. You just use limit orders. You have to chase markets sometimes, but if you use a market order, it's just a little bit of nicking and a little bit of slippage all the time. It feels better because you never get a big slippage that a limit order will give you. But overall, the limits are much better, even when you get the big problem where you have to chase it all day. But then someone else, one of our mentors, said, "Oh heck no! I just do market orders every single time. I don't really care. I just do a market order. I'm not going to screw around and wait for this." So I think, I think a combination: market orders, limit orders. Just don't, try to be a good trend follower every second of the day. If it's going your way, then be thankful that you can buy higher prices. I guess that kind of works. Um, and then you're not, if the market sells off a bit, even if it's above your buy entry, you don't want it to sell off too much and take advantage of that momentary counter trend sell off. Although I don't pay attention to that. Some of these markets I trade, they're pretty illiquid. So once I get committed to doing the trade, even if it starts to sell off a bit, I'll keep going just to finish it up. I'm going to hold on to that thing for a year, hopefully. So I don't really follow that idea to a T, but it probably works better to just try to buy higher prices all the time. You know, I did a back test one time to say, to try to force myself, to force the system to prefer to buy the high of the day. So I tried everything that I could to create a rule that says, put myself in a high likely situation to buy the high of the day. No one wants to do it. Traders hate it. So it must be the right thing to do. And of course, you can't really do it because it could keep going and make a new high. And so, anyways, the results of this back test of purposefully trying to buy the highs of the day and sell the lows of the day, it added about a 10% expectation to my trade. So there you have it. Doing what other people don't want to do is a good path to go down when you're thinking about research projects.
Love it, Jerry.
Yeah, taking notes here. Thanks, guys.
You know, thinking about execution, it is something that I also have studied and want to improve with our systems. And I think I have found that yes, you should be trying to advance your current portfolio to your expected portfolio um, as quickly as possible. There's definitely a trade-off between speed and price, but the cost is proportional to what your expected average trade win is. So like you can imagine that if your average trade in ATR terms is like 5 ATR and I gave up like half an ATR, which still could be like a pretty big move drift from your original point, then it's still relatively insignificant to your trading system. And it's just part of the reality of life. And it will be slightly random. It'll go up and down a bit more and a bit less, and you really don't know what it's going to be. But if you're trading faster term or your edge is tighter, then execution becomes a lot more important. Or if you have systems that have less edge in ATR terms, or like percentage terms, like the percent of your commissions and slippage versus the percent of your edge, then again, it becomes more important. And then there will be a point that maybe you're able to actually like catch rebates from exchanges, or you're able to reduce that cost, and then it becomes a scaling or maybe even an advantage to your competitors if you're able to build that technology. But again, it's such a marginal thing. You would have to have your trading game to like the top 90% of what you can do, and then and only then will trying to improve your execution by improving it by 1 or 2 ticks of execution, or even giving up half of an ATR really start to affect you.
Yeah, you're right. Once you're able to measure what slippage you're actually getting, then you can have a big a glimpse of what's the expected improvement of system if you improve your execution versus what would be better if you improve your system itself. And yeah, I'm a bit far from this less than half ATR being an issue. I think I have much more to develop on the system itself. And just to be clear, I do trade longer term, so this execution thing is not a problem most of the time.
Inevitably, Bruno, we're operating in that zone of the distribution of returns where slippage is always going to be a factor, because we're sort of trading in a more exotic, possibly highly volatile sort of regions where slippage is the norm as opposed to the exception. So, as opposed to trades during a normal daily market regime where you get nice fills and those sort of things in the zones that we inhabit, where things are starting to get a bit crazy. Slippage is always there, but I just factor that in as part of my linear losses.
Richard, I'd like for you to excuse me, explain to us some of the things you were tweeting about our weak edge. I thought that was pretty interesting, and maybe just a few words on what you meant by that.
So what that was a result of, Jerry, is that study I did. I put it up on YouTube. There was about 3 videos dealing with randomness and dealing with how you can simulate real market data through insertion of serial correlation in the market data itself. But what I certainly found with my co-worker Fred is that when we took any liquid market data of the typical instruments we trade, Forex, or we take commodities or whatever. Of course, we're in the CFD world, but we're still taking the relevant instruments that you guys take. When we take that market data and we bust up the correlation or bust up any serial correlation that exists in that data, and that's just simply through a process of randomization of the information in that data stream. And then we regenerate these random market data series that basically have busted up these moments of serial correlation in the data stream. And, Nita Hoffer was saying, well, who hasn't found much serial correlation in data streams? Well, we find lots of it. But anyway, when you do that and you apply your trend following models that you apply standardly to your real market data, you'll find that, over a 10-year period, we get this typical distribution of returns where we can't really tell whether we're performing well or we're performing poorly, because we get displayed distribution of performance returns that typically sort of adopt almost a Monte Carlo situation. But, as time progresses, they inevitably all decay. But as soon as we then apply those same models back onto that real market data, we find that we get this significant uplift in the performance of our equity curves. And the way we account for that is that there are only, specific periods in that market data over a 30-year, 40-year time frame where we get this serial correlation. So what that is we've all talked about how we can always predict volatility, which is sort of a bit of a furphy for me. But anyway, you can't predict the direction of volatility. You certainly can predict levels of volatility, up or down, but you can't say which way it's going to go. But what we do find with a serial correlated series is that in almost all liquid market data that Fred and I have tested, there are these serially correlated patches, and they are sufficient to account for these outliers. So in all of our market data instruments, when you plot the distribution of daily returns, you get this leptokurtic signature. You find that they all have tail events, and you find that those tail events all seem to coincide with these serially correlated patches. And you only need a very few of these serially correlated patches to develop all of your alpha. Lo and behold, when we look at our trade distribution, we find that 5 to 10% of our trades produce all of our profit. That's where it's coming from, those serially correlated patches. So that's what that was all about.
Yeah. Hi, everyone. I have a question, and I believe I'm the person who likes to think in images and words, and I'm like a heavy learner in psychology. And I think Jerry mentioned the personality. I know how important it is in trading, and even Richard said the feeling now. Trend following to me is like ultimately living in now. So I know I'm really weak in technicals. So unlike most of you gentlemen here, and what do you suggest how I can improve and how to start? Thank you.
You're at a good starting point here. Just what I tend to do is, whenever I start a new project, like a big complex topic that I've never sort of had much education about, the first stage is I say to myself, well, I'm not going to reinvent the wheel here. I'm going to jump on the shoulders of giants, and therefore, who are these giants? The first thing I do is I say, look to the validated track records, validated performance track records of those that have been extremely successful over a long period of time. Lo and behold, we find there's a huge bundle of them called trend followers. And then say, right, who are these giants? And then refer to their research, refer to the information they're talking about, and just sort of inhabit that zone. What you do find is when you stand next to these giants, you start absorbing their information, and you start finding that your philosophies change, and you start thinking like these giants. So that's how I do it, Lily.
Thank you, Richard.
Yeah, the way I'm traveling this trend following road is I first try to replicate the original turtle trading rules, or I believe it's the original. I've got from a paper in the Top Traders Unplugged website. You can find something similar in Covell's books. I tried first to replicate them, and then in light of these golden rules we talk about every every single week, try to think about these original rules, how they may be improved, still under the restriction of the so-called golden rules. Yeah, try to improve this rules. You don't need to have a very good grasp on mathematics and technical issues to understand trend following. It's much more of a simple set of rules that unfold in a good way to navigate complex markets.
Thank you, Bruno. Yeah, I feel like I'm improving even from last week to just 1 week. I'm taking baby steps. Yes, thank you so much.
Actually, Jerry, I don't think I answered your question totally. When we say weak edge, when I did say we found these, infrequent but some serially correlated patches, that's what I mean by weak. It's not present throughout all the data. There's clustered periods of serial correlation, but by far the majority of that data produces a random performance of the equity curve. And when I say random performance of that equity curve, it could be positive random performance, it could be negative random performance, but always recognizing that there is a negative friction in that randomness because of the trading costs, etc., of each of the trades we take, which ultimately all decay. We find therefore our performance might have, in an individual return stream, might have three non-random serially correlated components, but by far the majority of the balance of the trade distribution in that equity curve is random. So that's where we come to the conclusion about, we want to target outliers. We want to target these non-linear magnitude events as opposed to focusing on this random performance. We believe is not material to our overall performance over the long term. Therefore, how do we exclude that degree of randomness as much as possible, and how do we focus on those outliers?
Yeah, it's coming back to me now. I think it may have started when, or I chimed in. Oh, yeah, George. George knows how to start posting things on Twitter that gets me going. And I think it was something about Niederhofer. And Victor Niederhofer has been an anti-trend following person for a long time. And I remember Bill Eckhart, another article of his. I don't know if I can find this one, but it was something along the lines of, he was saying like, well, if you use traditional statistics, drawing lines through things and whatever that means, and it's hard to see that trend following has much going for it. The edges are pretty small, and maybe you'll miss it even, my words. And then, but if you need to run this, hokey back test. And if you run the back test, probably dependent upon some robust stats and using ATR, etc., then you'll see these things pop out. But using maybe more of a traditional method of analyzing performance, statistical method, you don't really see it as much. And then, one of the things I dislike is, get this out there, I dislike people quoting trend following statistics. It's just really counterproductive. And here's the rate of return you're going to get. Here's the drawdown that you're going to get. What? Come on. Everyone does it a different way. Some people are very successful, very consistent. Some people are not. Mulvaney is successful. I've had periods of success, and we do things probably very different. So his drawdowns there is no one standard return versus drawdown. And then can you imagine? A drawdown, a period where people have had very good performance, and the drawdowns were super small, and then their problems with their systems manifested themselves much later. And so it calls into question even the period where the drawdown was small. They were doing things that were eventually going to not work and create a much worse profile. So I don't like it when people post what trend following makes. There's too much going on there. It's too many things we can do ourselves.
I agree, Jerry. I went on a rant following that because I totally in your ball court here. And this is where I've got real issues with people that base performance or base things on a back test, because as I was trying to say on Twitter, the data or the back test results we get is always a result of there's always survivorship bias in that back test result. The backtest result, the way that contingent events occur over the course of time, we find that there are an incredible amount of failure events which are not recorded by the backtest. The backtest only records what has been successful, and hence why you adopt that backtest as a basis to project something going on in the future. But that's not how it works. The reason why, when we're standing here on the right-hand side of the chart and we don't know what's going to happen tomorrow, there could be multiple different possible paths towards the future. Why do we have this single path towards the past? It's because that single path of our history or our backtest is a path of survival. So in terms of trend following, if we anticipate that our performance returns are going to be the same as that historic past, we're dreaming, because we will not get a total sort of repeat of those contingent events across those series. If you just simply reshuffle those events, you get a totally different performance result. Plus, it fails to include all of the failed events that occur at each of those contingent points or events in that series, which is where I know people don't like me talking about it, but where we've got to deal with non-ergodic processes when we're talking about performance returns. Path dependence really does matter. And in statistical terms, when they're using a data set or whatever, it's a data set of survival. It's not a data set that includes failure. So the survivorship bias that is festering in all sorts of traditional statistical treatments, in artificial intelligence, and all of these different methods that do not include the failure components of each of these contingent events. And a Markov chain doesn't include the failure events. It just assumes a defined probability at each event which will occur or is known at the preceding stage. And we know that that's not the case. We get failure events occurring at each of those nodes. So there are all of these statistical tools we use in this sort of theoretical world we inhabit, which sound good. It's based on survival, but the reality is that, well, the future's not going to work like that.
Yeah, I agree. And these people are like so-called gurus with an agenda. I mean, I have noticed that no successful traders will ever tell you how to trade. They won't have a story to tell.
Yeah, I think it's misguided, but I think really it's because, a whole way of trying to understand these complex adaptive systems has been severely influenced by mathematical models that are very sort of they're complex. They look great, they look elegant, but they certainly depart from the reality of the actual system itself. We can only ever apply a model to try and anticipate how that system operates because we are participants that exist within that system. We are not participants that can sit outside that system like gods and observe how the entire system behaves, because this financial market is an open-nested, very complex arrangement of financial transactions that depend on humans, and therefore the humans depend on how they live and survive. Because as soon as you get these participants dropping off by death, and all of these events, the participant mix changes. It's not like a game of chess where the entire domain of probabilities is known or can be known at any possible point in time. It's a moving feast of adaptation over time because the participants change over time and their behaviors change over time. It's not just the behaviors of the individual participants that are important, it's how they all work together collectively and the gross imprint of all of these different manifested behaviors, how they move price. It's a feast of complexity, which I defy anyone to be able to work out.
When you talk about gurus, I think there's a fine line because there's a ton of traders who will tell you exactly how they trade, and it just isn't what novice traders want to hear, which is that price matters, trade long term, follow a strategy. Everything Jerry's preaching is by the book, and I think exactly how he approaches the market. And then you see gurus that say, well, you have to have this moving average and you have to have a smooth moving average, and they'll completely overwhelm you with a ton of nonsense. But sometimes the easiest statements are kind of the truest, and I think they're hardest to follow too. But realizing that is the first step in executing on it.
Yeah, this is unfortunate. It's like it appeals to the mass psychology, like the herd mentality. So it's like a sucker's game. So the people who lose are the suckers, I believe.
And one of the things that Rich talked about in the turtle classes was that he, would just do back tests based upon trading cliches and try to prove them right or wrong. And there's so many cliches out there, especially from people on Twitter who I think have a lot of followers and who are kind of trend and just a lot of sketchy ideas. But anyways, I'm going to say goodbye and get ready for my trip and leaving Florida, cold Florida, for even colder New York. But it's been fun and I've enjoyed it, and we'll pick it up next week again. And thanks everybody for attending, and we'll put the replays out there later. And everybody have a good weekend. Thanks very much.
Thank you.
Thanks,
Have a
Jerry.
good weekend. Thank you,
Thanks,
everyone.
everyone.
Thanks, everyone. Bye.